In this video, I'm going to be sharing with you what an alternative investment is, how to differentiate it from other types of investment, and why they will become increasingly important to your own wealth, and why you should care. This is an alternative investment, as is this, and this. If someone were to say to you what an investment looked like, what would you say? Would it be gold, a business, or the stock market? Leave a comment below as to what you think it is now, and come back to it at the end of the video, and see whether it's the same. At its most basic level, an investment can be considered deferred consumption, foregoing consumption now in the hope of greater consumption later. Though exactly how you defer that consumption, through what you put your money in, is key. In a nutshell, investments can be split between those we consider traditional investments and those we consider alternative investments, otherwise known as alts. Traditional investments can be broken down into three main categories: fixed income, such as bonds for example, publicly traded equities, such as shares in the stock market, and cash. Of these categories, fixed income makes up the largest amount, followed by equities, with cash as the smallest share of the pie. As we can see, traditional investments are commonly comprised of equities and bonds, a form of fixed income. Taking a second to explain these, equities are akin to a publicly traded stake in something, such as shares in a company, and bonds, at their most basic, are just basically the debt which an entity borrows from a person, company or institution, in exchange for a promise to repay the initial amount borrowed, known as the principal, plus any interest. These traditional investment classes are very important, as they account for the vast proportion of global wealth. In fact, it wasn't too long ago that your standard traditional portfolio, such as your pension for example, would be split between equities and bonds. However, this isn't supposed to be a video about traditional investments. Focusing only on traditional investments would be akin to viewing the Mona Lisa through a microscope. You would be depriving yourself of a much wider economic landscape. This landscape is made up of everything we would consider alternatives, or otherwise known as alts. There is no one universal definition, though the industry leader in alternatives education, the Chartered Alternative Investment Analysts Association, or CAIA for short, has defined an alternative investment as any investment that is not simply a long position in traditional investments. This type of exclusionary based definition is vague on purpose, as alts come in all different shapes and sizes. To help conceptualize this, alternatives can be split into several main groupings. If we take a look at the global investable market for these groups, they would account for these weightings you see on screen now. Tallying all these categories up equates to a total alt investment market globally of about $13.4 trillion. As you can see, the market is dominated by private equity and hedge funds. Now taking a second to describe these two in a little more detail. Private equity is an ownership interest in an entity that is not traded, whilst hedge funds are a form of partnership between a managing partner, who manages a pot of money, and limited partners, who contribute capital to the fund but leave the day-to-day decisions to the managing partner. To put the market for alts in context, the total market for traditional assets is believed to be just over $100 trillion. This dwarfs the market for alts. Taking a look at this pie chart helps to put things in perspective, where alts make up only 12% of the global investable market. So granted, alts are a small proportion of the global investable market. However, they are a growing segment of the market. Alts have already doubled from 6% in 2004, and according to a survey of 1,000 CAIA members, alts' share of the investment pie is expected to grow to somewhere between 18 to 24% by 2025. All of this suggests that alts are of significant and growing value, since they have doubled in size since 2004 to be more than a tenth of the market to date, are back to be up to a quarter of the market in the next 5 years, and will no doubt continue to grow in importance beyond 2025. However, why should the average person outside of a hedge fund or private equity house care about alts at all? The answer to this is actually twofold. Firstly, changes in technology will mean alts will make up an ever greater share of investable products. Fractional ownership, the growth of the retail consumer market, the internet, and cryptocurrencies will all have their part to play. And secondly, pension funds. And this is a big one. Pension funds in many parts of the globe have been running deficits for years and are therefore continuously looking to diversify their portfolios and seek ever greater returns, with alts offering the perfect platform to achieve this. The UK government's advisory group for Parliament on pension funds has suggested low returns in traditional markets are making alts a more attractive option. According to the group, over the last 20 years, for a UK investor, Global equity returns have averaged 8%, and UK government bonds 6.5%. A classic 60-40 balanced portfolio between the two would have returned over 7% per year. Over the next decade though, modelling suggests a return of 3% per year is a realistic expectation. What this suggests is that the average return of your traditional assets will decline by about 4% over the next couple of years. However, the group goes on to suggest that by including a much wider range of assets and diversifying more aggressively, provides a route for investors to do significantly better. The group expects a diversified liquid portfolio to achieve 5 to 6% per year, and 7 to 8% for those who can allocate to good private equity and debt funds. Statements like this only go to highlight the problem traditional investments are facing and the unique and beneficial role that alts can play. In effect, returns and wealth creation are already and will be increasingly driven by alts. This drive towards alts is further driven by lower interest rates. Even before the current crisis caused by the coronavirus led to record low interest rates and quantitative easing, a topic we will be covering in a future video, the last 2 decades have seen global interest rates move to record low levels. Therefore, the perception of alts as a potential knight in shining armour is a key driver of the industry. But is this view the same for all alt classes, or just some of them? Well, according to a survey by CAIA, the core drivers of alts are diversification, where you look at assets which are not correlated or move in the same direction as assets already in your portfolio, yield enhancement, which means they offer stronger returns, enhanced performance, and inflation hedging, which means they act as a good counter to inflation by increasing in value when inflation erodes the value of money. These were all hugely important factors, though the importance they play is largely dependent on which type of market you're talking about. That very same survey found that hedge funds look towards diversification mainly, private equity more towards enhanced performance, real estate and infrastructure to inflation hedging, and private debt or structured products for yield enhancement. As you can therefore see, alts wear many different hats and therefore must be treated differently. But perhaps most importantly, how do these different categories of alts perform against each other? Taking a look at this graph of the performance of managers across different subsectors suggests a variety of things. Imagining for a second that you were an investor with a few million to burn, how would you allocate that? If you were to blindly focus on the top quartile, that is to say the top 25% of managers in their respective categories, hedge funds would have had the highest returns on average. However, they had one of the lowest average overall returns for the sector and the lowest bottom quartile performance overall. What about if you just wanted a stable performance? In that case, perhaps public global fixed income may have been a good shout according to this graph. What this graph truly shows though is that some alt classes are more unequal than others, but all of them carry risk. A key question to ask at this point then is how would you go about limiting that risk? Short of not investing your money at all, moving to a remote desert island and whittling spoons for a living, the only thing you can do, which stands head and shoulders above everything else, is thorough due diligence. As dry as it may sound, due diligence is one of the most important drivers to success, and alts are no different. Poor due diligence has been found to be the leading risk in investments of alts. Take a second to think about that. That means it's not changes in market values, but the poor operational performance of managing companies themselves that pose the greatest risk. Alts are prone to these risks because of their very nature. They operate often in opaque and imperfect markets. As such markets can easily lead to operational risk, which can be simplified to be the uncertainty in economic outcomes resulting from imperfect implementation of a fund strategy. Combating operational risk, therefore, is the key to unlocking the hidden wealth of alts. This very fight can quickly rack up a huge bill. You may be surprised to learn that performing a comprehensive due diligence on a single fund can take anywhere between 75 to 100 hours and cost in excess of $50,000. And bear in mind, this is per fund, a fund which may not be invested in at the end of the process. So after saying all of this, which type of alts are set to grow the most? The top touted alternative asset class is private equity. That shouldn't come as too much of a surprise if we look back at the graphs earlier. PE had the highest average compound annual growth rate at circa 14%, and one of the highest top quartile average returns overall. Not only that, Private equity has grown dramatically over the last decade. Investor allocations, the outperformance of private equity versus public companies, and market appreciation have grown private equity global assets to their highest ever levels. To get a better understanding of how important private equity has become, take a quick look at this graph. What we can see here is the growing war chest of unspent money private equity has to spend, otherwise known as dry powder. So don't be surprised when you next hear of a PE fund taking over a business you interact with, as the industry continues to grow and has a seamlessly unlimited amount of cash to spend. However, it's important to remember why PE has seen the cash pouring in recent years. Many attribute this to the record low returns in bonds, which make PE too good to miss out on. Though there is increasing concern that investors are becoming too optimistic over the returns private equity can deliver. And this concern will be something to watch out for in the future. Whether increasing amounts of money chasing returns can lead to the same performance private equity has enjoyed over the last few years, or whether this will lead to overcrowding and bring the overall average performance crashing down. Overall though, it's clear that alts are here to stay. Their prominence in our economies and opportunities to create wealth has never been higher. It's this growing importance of alts in wealth creation and how they have and will increasingly impact all of us, which many people find interesting. This rise of alternatives is something we at Alt Simplified will be trying to cover in future videos. We would love to hear what your views are on this in the comments below. And if you like this video and want to see more, please do remember to hit the subscribe button so we can continue to make more of these videos. See you in the next video.